Benjamin Graham's The Intelligent Investor, first published in 1949, is a well-known acclaimed book on value investing. This book contains strategies for using value investing in the stock market. The book has been one of the most popular books on investing in the history, and Graham's legacy remains. You won't learn how to beat the market from this book. On the other hand, it will teach you how to minimize risk, protect your capital from loss, and consistently generate long-term, sustainable returns. Warren Buffett calls The Intelligent Investor by far the best investing book ever written. Benjamin's tried and true method of value investing substitutes risky attempts to predict future share prices for sound investments based on the underlying value of the company's tangible assets. Welcome to my channel, the Taurus Treasury. To know about the top 5 investing lessons from Benjamin Graham, watch this full video. If you like my videos, please hit the like button, subscribe, and click on the bell notification so you do not miss out on any opportunities. Benjamin Graham's book, The Intelligent Investor, gives all that you want to gain the investor's mindset and keep away from the ordinary investor's experience when market changes happen. Don't be ordinary, be intelligent. He excelled academically at Columbia despite his poverty, and after graduating, he began his investing career working on Wall Street. In 1949, he wrote The Intelligent Investor, which Warren Buffett claims is the best investing book ever written about his investing principles. Here are some examples from Graham's book to assist you start investing. Analyze over the long term, protect yourself from losses, and avoid excessive profits. Never put your faith in Mr. Market because he can be very irrational in the short and medium term. If you make all of your investments in accordance with a precise formula, you will succeed. Ready to become an intelligent investor? Let's get going. Prior to making a speculation, an intelligent investor generally looks at an organization's administration standards and long-term improvement. Generally, they diversify their investments to guard against losses. Intelligent investors focus on steady and secure returns rather than exorbitant profits. A well-known quote by Warren Buffett is about his 2 principles for effective money management. Rule no. 1. Never lose money. Rule no. 2. Never forget Rule no. 1. That is precisely what intelligent investing entails. Everyone has the ability to protect themselves from losses. Anticipate the following Facebook. Intelligent investors look for stocks that have a gap between their current price and the company's intrinsic value that the company possesses and will eventually unlock by doing a thorough analysis. This is based on the evidence gathered by looking at the company's history and management values. To abstain from losing everything in case of a disappointment, the smart investor puts money into a small number of these businesses and then sits back, being perfectly happy with gathering 10%, 12%, or even 15% a year in returns. Never trust Mr. Market. The Mr. Market analogy, in which he depicts the entire stock market as a single person, is Graham's most well-known one. How would you respond if Mr. Market showed up at your door every day and gave you different cost estimates for different stocks? As per Benjamin Graham, you'd be best off ignoring him altogether every day of the week. He would inform you of prices that at times appeared suspiciously low and at other times extremely high. This is because of Mr. Market's absence of knowledge, complete unpredictability, and serious emotional mood. For instance, a month or so prior to the release of a new iPhone, stocks surge, drawing crowds to the Apple Store. But when the new phone is not exactly as expected, stocks can plummet the very next day. We humans try to find patterns even when there are none because we are so good at recognizing them. Along these lines, we normally expect that a stock value that has been rising for 10 days should keep on rising, which is obviously not the case. If you want to be an intelligent investor, depend on your own research and ignore the market altogether. The issue of inflation. Cash loses value over time. For instance, $1 10 years ago is worth more than $1 today. Therefore, in order to beat inflation, we need to invest cash rather than keep it in cash. The majority of investors, despite this, do not take inflation into account. Psychologists refer to this as the money illusion. A 2% raise in compensation is actually a cut in our available money on the off chance that inflation has increased at 4%. Despite this, Many people would prefer to accept a 1% decrease in salary in a year when expansion is at nothing. Therefore, rather than focusing on the amount of money you are making from your investments, focus on the amount of money you keep after inflation. Don't let age influence your investing. In Graham's opinion, that your capacity to put time and effort into your portfolio and your circumstances will determine which type of investor you should be. It shouldn't be based on your age or willingness to take risks. These guidelines from Graham demonstrate that age shouldn't mean for on your ventures. An 89-year-old with $3 million, a sufficient pension, and multiple children would be foolish to invest most of their money in bonds. This individual has sufficient money already, and their youngsters would inherit their stocks. A 25-year-old who is putting something aside for a house store and their wedding should never invest all of their cash in stocks. Both of these scenarios make it difficult to follow the general advice to switch cash from stocks to bonds as you get older. On the other hand, other aspects are more important. All things considered, the qualities of your work, the number of people who depend on you, and different elements should decide your sort as an investor. Always stick to a strict formula and you'll do fine. Last but not least, when investing, you should always follow a strict formula to avoid the emotional stress of investing with the market. Although it is more commonly referred to as dollar cost averaging, Graham refers to it as formula investing. This implies that you essentially set a fixed amount of money to invest every month or quarter, and afterward put that cash into the stocks you've picked, regardless of how much they cost. For instance, I put 10% of my monthly income into investments. I invest that money in stocks I already own after it is automatically deposited into my investment account. This is somewhat emotionally demanding, on the grounds that it expects you to contribute a similar amount over and over. No more when stocks are less expensive, no less when stocks are costly. In any case, when you deal with it, it's a great way to avoid losses that could occur if you invest a large sum right before a crash. The defensive investor. The appearance of safety or risk is inversely driven by price direction. You want to have an exposure to stocks consistently, regardless of whether stocks are costly. Because of reasons previously given, we feel that the defensive investor can't stand to be without an apparent extent of common stocks in his portfolio, regardless of whether he should see them as the lesser of two evils, the greater being the risks attached to an all-bond holding. That's all for today. Hope you enjoyed the video. If you have any questions regarding this, let us know in the comment section. Like and subscribe the video, and don't forget to hit the bell button.